Hello, everyone, and welcome back to the White Tower for the third Sustainable Finance Summit. We're so excited to welcome you again. And what a great way to start this day with our keynote fireside chat, which is going to be on green money, red line, and geopolitical risk. This conversation, of course, couldn't be more timely. Today, we'll explore how geopolitical instability, regulatory shifts, and climate risks shape the current global agenda. Joining me is someone who needs no introduction. Thank you very much, Kevin, for being here with us. Kevin has spent over 2 decades in the forefront of financial supervision and risk management. He had a role at the Federal Reserve Bank of New York and the Federal Reserve Board. Kevin co-chaired the Basel Committee on Banking Supervision and also the Task Force on Climate-Related Financial Risks. So today, he's a senior fellow at Resources for the Future, focusing on sustainability and systemic risk. So thank you very much for being here.
Great. Well, thanks very much for inviting me. It's really nice to be here today.
Great. So let's start with your role at the Fed, Kevin. So you spent almost 2 decades. During that time, the US and global economy went through a lot of changes. First with the 2008 global financial crisis, then the pandemic in 2020. You also led the climate efforts at the Fed. What was the job like, and what have we learned from previous crises that potentially can help us to mitigate a climate crisis?
Right. So I spent 25 years at the Federal Reserve in a number of different roles. First as a research economist, and then in supervision during the financial crisis. I worked in the market desk at the New York Fed where monetary policy is implemented. And I think the 2 big lessons that crossed all of that. So one is that unprecedented things do happen. And whether that's a 15% decline in house prices that led to the great financial crisis, a pandemic that had a big short-term economic impact and a much longer-term impact on the way we work and live. And then even in March of 2023, when a venture capital-inspired run on a medium-sized bank in the US led to a mini financial crisis. So the way you deal with that, the potential for these unprecedented events, is really the need for broad-based resilience. And what I mean by that is financial resilience, strategic resilience, operational resilience, because we can't predict what the next shock will be, but a financial sector that is resilient to a broad range of outcomes is likely to lead to better outcomes. The second thing I learned is that when you have these kinds of very complex problems, you do better when you approach them from multiple perspectives. So you don't need 100 economists. You need some economists, some lawyers, some accountants, some bank supervisors. You need financial analysts. You need a broad range of perspectives to help solve these problems. And there's a large academic literature on the value of cognitive diversity. And in my experience at the Fed, that's where we did the best work and the most durable work.
That's very interesting. And we do understand that, from a regulatory point of view, it makes sense to, ensure that you have a stable economy. There is a lot of resilience. You monitor closely, from a central bank perspective, interest rates and all of that. But why regulators should care about climate? From a supervisory perspective, what makes climate risk relevant to financial stability?
Yeah, I think this is a really important question to get the fundamental motivation down at the beginning. And I can talk about this from both a microprudential perspective, thinking about the risks for individual firms, and also a macroprudential or a systemic perspective. So if you think about what supervision does, the goal of supervision, the purpose of supervision, is to ensure that banks manage all material risks, whether that comes from a geopolitical shock, a cyber shock, a business cycle, or from the financial risks of climate change. So the basic motivation is a risk management perspective. And I think it's really important to put this in this broad framing because climate change isn't a new shock, isn't a new risk. Rather, it's a driver of existing risks for the financial system. So the question is, how can the physical and transition risks related to climate change impact credit risk, market risk, operational risk, all the risks that banks already manage? But the challenge, the new piece of this, is that climate change brings a set of distinctive attributes that require additional focus. So, for example, climate change is a secular trend, not a cyclical trend like a business cycle. It's full of massive uncertainty. Uncertainty about how the climate will evolve, how the financial system will adapt, how the economy will respond. Banks need to build robustness to that range of uncertainty. And then third, climate change is a situation where the past is unlikely to be a good predictor of the future. So that means we need new data, new models, new expertise to understand and manage these risks. And all of that is a very traditional risk management perspective. How does the financial institution manage, monitor, and adapt to risks? I've said nothing about net zero commitments or transition plans or goals to decarbonize the broader economy. Really thinking about it from the micro-prudential perspective. You can also think about it from a more systemic perspective. And for me, systemic risk is about amplifiers, increased correlations, situations where risk transfers from one part of the financial sector to another. And climate change has the potential to bring all of those types of features. Severe weather events can change the correlations of shocks. Tipping points can be effectively amplifiers for the climate and for the real economy. So I think from both a micro-prudential and a macro-prudential perspective, it's very core to the business of supervision to think about climate change as a risk driver.
Yeah, and it feels, based on what I'm hearing, it fits very nicely the traditional risk management framework, which is very much, let's identify the risks that we are facing, let's measure it and monitor it over time so that we know how to proactively manage the portfolio. Very interesting. And you know, in all the data that you shared with us, in 2013, the Fed went ahead and launched a climate scenario analysis exercise to really try and understand, you know, the level of readiness, you know, within the large financial institutions in the US around embedding within the risk management framework, transition and physical risk. So through that exercise, and you led the effort at the Fed, what stood out to you, both in terms of their level of readiness as well as some of the gaps that you saw in the market?
Right. So in 2023 and 24, the Federal Reserve did a pilot climate scenario analysis exercise where we worked with 6 large banks with 2 very specific goals in mind. One was to understand what banks were doing, and 2 was to build capacity, both at the banks and amongst the supervisors. And we published the results of that exercise in 2024. A couple of the results that I think were probably most interesting were analytically, empirically, the estimated impact was quite limited. And this is consistent with a number of other recent large-scale scenario analyses. OSFI completed one, the Bank of England, the ECB did one a few years ago. In some ways, that's not surprising because of the nature of the exercise. They weren't big dramatic tail events where there's a big climate tipping point, where there's fundamental breakdowns in financial markets. We only looked at large banks, who are in some ways the best positioned to manage these risks, as opposed to small, undiversified banks in the United States. Another thing that was interesting was the data gaps. So across the largest banks in the US, we heard a lot about the insufficient amount of data that they had at a granular level to really understand these risks. Things like, do you know the characteristics of the property where you have a loan? Do you know the age, the structure, whether there's been adaptation investments? There were gaps around insurance information, the replacement cost, the deductibles, really basic information that the banks knew but didn't necessarily have in a easy to access database form. There were gaps around banks' understanding of their borrowers' transition capacity. What were the borrowers doing to manage these risks? Another key takeaway was around uncertainty. And we heard from the participants in the exercise that it's really difficult to run your business for a modal outcome when you're also worrying about these very extreme tails. And that's a fundamental risk management challenge when you need to make business decisions on a day-by-day and quarter-by-quarter basis with this big uncertainty. And then the last piece, which gets to maybe the relatively small empirical results, was that neither the supervisors nor the participants had a really good understanding of the indirect effects. So the models that banks had typically did a good job of saying, if a hurricane hits this region and I have a loan to this commercial real estate or residential real estate property, how does the probability of default change? It was much harder to say, well, what happens if core infrastructure is damaged? What happens if there's population migration? What happens if there's shifts in local economic activity? And these indirect effects that can act as the amplifiers that I mentioned before. So those were all some of the challenges that we observed in this exercise. And I think they're pretty consistent with the exercise that OSFI just completed, those same types of observations.
Yes, this is what we see in the market, and also we have Stefan in the next panel who can share a bit more, not to advertise the next panel, but Stefan can share a bit more about the Canadian reality, and you're absolutely right. These pilot exercises across the globe have helped the financial institutions to build the fundamentals, I will say, understand some of the complexities when it comes to the modeling approaches and the data. Beyond that, though, as you mentioned, when we think about climate risk, the expectation is that we go beyond the pilot exercises, right? And we think about how do we embed climate risk consideration within the underwriting process? How do we embed climate risk consideration within the overall stress testing framework and capital planning? Although it's been a few years, though, that we run this pilot exercise across the globe, when we look at the market, we don't see as much progress when it comes, again, to stress testing, business as usual, your capital planning. What's your view on that, both on the banking side and the insurance side?
Yeah. So I think it is a work in progress. And if you take the point of departure that this is a risk to be managed, the place that this type of analytical work, this type of risk management work belongs is firmly embedded in the core enterprise risk management structures of the institutions. To me, it doesn't make any sense to have enterprise risk management here and climate risk over there. Climate is a driver of traditional risks. It might behave or might have distinctive attributes that are different. You might need new data, new expertise, but fundamentally, you want to understand the impact on your traditional risks. So at least in the US, I think we're at a bit of a inflection point and almost a natural experiment. And what I mean by that is we saw a lot of talk about climate-related risks in 2020, 21, 22, much less in 2024 and 2025. So why is that? Why were banks investing and talking about this more in the past? Well, I think it was some combination of supervisory and regulatory pressure, investor demands, and then just good fundamental risk management, good business decisions. The first two of those are effectively gone in the US. There's little to no supervisory pressure at the federal level. Investors seem much less interested in the green halo associated with ESG investing or social responsibility goals. So what's left is, do banks think this is a good business decision to build the capacity to work with their clients, to understand the risks and incorporate them into the business? And that's the open question that we'll see.
And that's a really good point, and I want to take that. So what we've seen now, especially with the new geopolitical environment, is that financial institutions focus a bit more on the physical risk assessment rather than transition risk that is more like policy-driven. How do you feel about that? Do you think that focus on the physical risk side, by focusing on the physical risk side, we are building the right capabilities that will be needed going forward? Or are we missing potentially some long-term strategies that the institutions would have been able to build if they were also focusing on transition risk?
Yeah, so I completely agree with the premise, with the question. that the focus has been on physical risks. And I think there's a couple reasons for that. One is these physical risks, again, in the US, are materializing now. This is not a 2050 or a 2100 event. These are changes to the way severe weather events happen in the US that have economic impacts now. So in the US in the last 18 months, the LA wildfires had approximately $100 billion worth of damages. Hurricane Helene was close to $80 billion of damage. Hurricane Milton was over $30 billion of damages. And in all three of those cases, the dynamics of the event were different than what we had observed in the past. And you can't say with any certainty this event was caused by climate change, but I think the science is clear that climate change makes those type of events more likely to happen in the future. And that's the point we were talking about earlier. So the physical risk side is a reality. And I think there's also a political economy portion of that talking about transition risk almost necessarily includes winners and losers, reallocations across sectors, some regions or sectors doing better, some sectors doing worse. And I just think that is politically fraught right now. So I think another interesting question will be, is it the case that banks are paying attention or banks are doing less on this, or are they just talking about it less? And The Economist had I thought, a pretty good summary article on this shift from greenwashing, the concern that maybe the financial sector was overstating what they were doing, to green hushing, where maybe the financial sector is managing the risk, but they don't want to talk about it because of some of the political implications.
And I think that's an excellent point. And for those of you that attended, I saw some of my clients here that also attended the New York Climate Week. That was one of the main observations. And some of the things that we've heard in the panels, that it's not necessarily that they're not doing the work, but potentially they just talk less about it. So yeah, definitely that's consistent. You mentioned about some of the big losses that came from, some of the recent physical events, like everyone now is aware about the fires in California, the hurricane in North Carolina. Given the importance of insurance assumptions in, when we are estimating physical exposures, given the importance of physical insurance assumptions, what do you think? How well do you think, institutions, banks, and also insurance are now thinking about the assumptions, making them more sophisticated so that they can get closer to the reality? I'm sure you've seen that as part of the pilot as well, and we've seen it while we're supporting financial institutions. The moment you start playing with the assumptions and you trying to predict what it will happen in the future in the sense of which areas will be insured versus not and all of that, you can start seeing significant losses in portfolios.
Yeah, I think the insurance point is really important. In some ways, it is the tip of the spear in the US, and I don't think I'm in a meeting like this where insurance is not the focus. And that's true in North America, it's true in Europe. So if you think about what determines the loss to a financial institution, lots of factors. You have the actual economic losses that depend on the frequency and severity of the events, adaptation investment. You worry about the bank's lending exposure, where do you have positions? You worry about mitigants like insurance or government support. And then you worry about these amplifier effects. I think all of those are arguably getting worse from the financial sector's point of view, with insurance getting a lot of focus because we see changes playing out in real time that affect real people. It's sort of become a kitchen table issue in the United States in terms of the affordability debate. And there's a growing body of really good academic research that documents how the insurance industry is changing in the United States. And in regions where there's growing physical risks, you see premiums going up, house prices going down, defaults to banks going up, non-renewal rates going up, insurance coverage going down, underinsurance growing. So all of those are completely predictable events and ones that will shift who ultimately bears the loss back to the financial system or to the borrowers who are now insufficiently insured. So understanding those dynamics, I think, is really important. In the US, we have this bizarre system where, insurance is regulated at the state level. So each state has its own set of programs and policies, different sorts of pricing limitations, backstop insurance funds, availability of who can enter the market. So that's very fruitful for research economists to try to study what's going on. Your point about just understanding the interaction between insurance and banking reminds me of an anecdote that the Bank of England said when they did their climate scenario analysis. They told us that the insurers told them, or the banks told them, don't worry, we're insured. And the insurers told them, don't worry, we have one-year contracts, we'll be out before anything bad happens. So that's the kind of macroprudential transfer of risk across sectors that's really important to understand.
Thank you, Kevin. That's a very interesting point, and it really, helps to show, some of the uncovered risk that it's there and potentially not appropriately, measured at the moment or monitored. So thanks for all the insights for the Fed. So now let's focus a bit more on the now and the future. You have chosen to join Resources for the Future that focuses more on, policy innovation and research. Tell us a bit more about your current role and, how you can drive innovation.
Yeah, so I, after a long career at the Fed, I recently joined Resources for the Future, which is a non-government organization, a think tank in Washington that focuses on the impact of climate change on the economy. A long history of really high quality analytical work that built a reputation for independence, research integrity, and contributions in a very substantive way to the development of appropriate policies. So I'm going to help Resources for the Future build out their program on resilience and the financial risks of climate change that will leverage the work that we've done previously.
Amazing. Can you just, give us some more insights in your recent collaboration with Harvard and what you're aiming to achieve through that?
Yeah. So we recently launched a research collaboration effort between Resources for the Future and the Salata Institute at Harvard University, which is their endowed research institution. And the goal there is to try to bring together this broad cross-section of industry participants to better understand the financial risks of climate change. So academics, economists, finance scholars, the private sector, NGOs, former policy officials like myself to come together and try to build some capacity so that we'll be in a better position to make good policy in the future. There are really three mutually reinforcing goals from this collaboration. One is fundamental research to deepen our understanding of how climate change can impact the financial sector and real economy. The second is to promote good policy making, building off that academic work. And the third is a longer term goal, which is to build the research capacity over time by giving opportunities to more junior researchers, more junior scholars, so that there's a broad bench to do this kind of work going forward. And this is a real gap in the United States right now. There isn't a collaborative effort like that, so we're going to try and fill that gap and continue to build out the work going forward.
It sounds that, if I take it to what you shared in the beginning, it sounds that collaboration or partnership model is what is going to help to drive a more resilient, financial system going forward.
I think that's absolutely critical. And as I said at the beginning, in my experience, you do better solving complex problems when you have these multiple perspectives. And working with the private sector, working with NGOs, working with the public sector, they're all different perspectives, different trade-offs, different constraints on how you approach problems, and bringing those together will build better answers and more durable answers, particularly from a policy perspective, when you're involved with the financial sector.
Amazing. Thank you very much, Kevin. We are at the end of our, fireside chat. Any, last words, something that you might want to just share with this group as we go through the day?
Yeah. Well, maybe one part over the last few years, one thing that I found to be critically important in all of these discussions is to be very clear at the beginning of what the objective is when we're thinking about the financial risks of climate change. And you can have multiple objectives. There are risk management objectives. There are growth and opportunity objectives to work with clients, to help them manage their risks, to help them manage the transition. There are corporate social responsibility goals that some firms have, that some central banks have. But to be very clear about why you're undertaking certain actions, why you're taking certain perspectives, and always have that sort of a North Star when you're thinking about how you approach a complex problem like this.
Amazing. Thank you so much,
Thank you
Kevin.
for having me. This was a lot of fun.
Great.
Thank you.
Thank you.